A very, very good morning to one and all. I am deeply honored to welcome each and every one of you to this exclusive webinar hosted by Lemon Consultech. We are a consulting, auditing, and technology service provider operating globally across India, Dubai, Botswana, and Hong Kong. I am Neve Jogani, and today we gather to discuss a topic of utmost importance for businesses operating in Dubai, namely the new corporate tax regime. As you all are very well aware, Dubai has undergone significant changes in the past few years with the introduction of new regulations aimed at creating a more favorable environment for businesses to operate. This new tax regime is a crucial part of these changes, and as business leaders, it is imperative to stay informed and updated to ensure your success in this dynamic marketplace. So let me take a moment to walk you through the agenda for today's webinar. We will start with an overview of the new corporate tax regime in Dubai, followed by discussion on its free zone persons, exemptions, computation of taxable income, and tax losses. We will then delve deeper into specific aspects of the transfer pricing and some VAT amendments, along with tax groups and some other key points. Finally, we will wrap up the session with a Q&A segment where you will have the opportunity to ask any questions you may have. So without further ado, let us dive straight into the topic at hand. So under this new law, business with an income exceeding 375,000 dirhams will be subject to a 9% tax rate, starting from the financial year that begins on or after 1st June 23 in accordance with the applicable CD regulations. So the introduction of this new tax regime aims to support the UAE's competitive and productive economy, encourage growth, attract foreign investment, and adapt to the evolving international and domestic tax developments. Furthermore, this tax regime is a step towards the supporting the global minimum effective tax rate as proposed under the Pillar 2 of the OECD. So, who all are the taxable persons who will be taxed? Under the UAE's new corporate tax regime, there are two categories of persons who will be subject to corporate tax: resident and non-resident persons. Resident persons include judicial entities incorporated in the UAE, natural persons engaged in a business or business activity within the UAE, and foreign companies that are managed and controlled within the UAE. On the other hand, non-resident persons are entities that meet any of the following criteria. They have a permanent establishment in the UAE, they derive income from a source in the UAE, or they have a nexus in the UAE. A permanent establishment can be any place where a business carries out its activities, whether it's a branch office, factory, workshop, or any other fixed place of business. So the UAE's new corporate tax regime provides exemptions to several categories of persons. These include government and government-controlled entities that are not engaged in a business under a license, persons engaged in extractive businesses, persons engaged in non-extractive natural resource businesses. Some other exempt persons include qualifying with public benefit entities, that is similar to India's Section 8 companies, or some other qualifying investment funds, public pension or social security funds, and judicial persons incorporated in the UAE that are wholly owned and controlled by exempt persons that undertake some specified activities. And it is important to note that the cabinet may also determine any other persons who may be exempt from the corporate tax under this regime. So, under the new UAE tax residency rules, an individual will be considered a UAE tax resident if they have the usual or primary place of residence and the center of financial and personal interest inside the UAE, or if they have been physically present in the UAE for 183 days or more during a consecutive 12-month period. Additionally, if an individual has been physically present in the UAE for at least 90 days in the consecutive 12-month period and is a UAE national, holding a valid residence permit such as the Emirates ID or a valid visa in the UAE, or holds a nationality of any GCC member state, which are the Gulf countries such as Oman or Qatar, and has a permanent place of residence or carries on an employment or business in the UAE, they will also be considered a UAE tax resident. It is important to note that the India-UAE double tax avoidance agreement supersedes the 90-day rule, and a person will be considered a resident of the UAE only if they stay in the country for a period of 183 days or more, if they are an Indian citizen. So for a judicial person, they will be considered a tax resident of the UAE if they are incorporated or otherwise formed or recognized in the UAE, or if they are considered a tax resident of the UAE under applicable legislation. So taxability of natural persons. So the new UAE corporate tax law will apply to individuals engaged in taxable business or business activity in the UAE, either directly or through an unincorporated partnership or sole proprietorship. It is important to note that natural persons engaged in a business or business activity through an unincorporated partnership are individually subject to an UAE CT on their share of income from such partnership deducted from their share of expenses. The share of expenses can be deducted on the basis of the contribution and profit sharing ratio. However, salaries and other employment income, real estate investments in personal capacity, dividends, capital gains, and any other income earned from holding investments in personal capacity, and interest or other income from bank deposits or saving schemes are not subjected to UAE CT. Additionally, any business income arising to a business person is also not subject to CT, given that the company is also registered as in the corporate tax. So the only income that is subject to CT for natural persons is the income that derives from any sole proprietorship business or an unincorporated partnership. Additionally, individuals having multiple business activities that fall under the scope of UAE CT can file a single CT return that covers all their business activities in sole proprietorships or partnership forms. So the taxability of entities operating within free zones in the UAE presents a complex and nuanced topic that requires a comprehensive understanding of the relevant regulations and legislation. So a qualifying free zone entity is an entity that meets all the four following conditions. A, it maintains adequate substance in the UAE. I believe the term adequate substance used above will be as per the economic substance regulations, the ESR law, which is already prevailing in the UAE, which requires the relevant persons to have adequate physical assets, operating expenses, and employees in the UAE to comply with the ESR law. Furthermore, the entity derives qualifying income, which is yet to be specified by cabinet decision. The entity has not elected to be subject to corporate tax. So for now, entities have an option to either avail the exemption and pay the tax at 0%, or they can choose to not be elected to CT and pay tax for the non-qualifying taxable income at the rate of 9%. And additionally, the entity complies with all the other laws and meets conditions as may be prescribed. So if an entity meets all these conditions, they are considered a qualifying free zone person, and their qualifying income will be taxed at 9%. Any other non-qualifying income will be taxed at the rate of 9%. Qualifying income will be taxed at 0%, and all the other non-qualifying income will be taxed at the rate of 9%. And if a qualifying free zone person fails to meet any of these conditions at any time during a tax period, they will no longer be considered a qualifying free zone person from the beginning of that tax period. For example, if a company having a financial year from January 1 to December 31st, and they contravene any of these conditions for say September, then they will not be considered a free zone entity and will be taxed for all their income earned before September and for the entire financial year. So, keeping these provisions in mind, a major dilemma that is created for businesses having a holding company in the free zone and its subsidiary in the mainland or vice versa is whether to avail the exemption or to opt for the full 9% CT rate and avail the benefit of transfer of tax losses, which is not permissible for entities in the free zone and will be further discussed in the later part of this presentation. The provisions do not specify whether a judicial person being eligible to file tax returns as a qualifying free zone person can change to normal tax regime only once. Hence, it is commonly interpreted that businesses can opt to be taxed at the standard rate at any time and would be effective from the succeeding tax period. Just to clarify, free zone entities would still be eligible to avail and carry forward the tax losses for their own businesses up to 75% each year, which will also be later discussed in this presentation. The Cabinet is also yet to provide clarity on the list of designated qualifying free zones. For example, in the VAT regime, some common free zones were left out of the designated free zone list, such as DMCC, and it would be interesting to see whether the same is applied in the UAE CT as well. And also a clarification is much required for qualifying income, which is the income where a free zone person would have to pay tax at the rate of 0%, and all other income would be qualified as non-qualifying income, wherein the tax rate would be 9%. However, it is commonly interpreted that any income sourced from the mainland would be considered as a non-qualifying income, and all other income sourced from free zones or sale from exports will be considered as qualifying income rated at 0%. So, what is included in taxable income? Business entities would be taxable for their income derived from the UAE or outside the UAE if it is effectively managed and controlled in the UAE. Like we already discussed, natural persons would be only taxable for the business income acting as a sole proprietorship or an unincorporated partnership, and non-residents would be only taxable for their income from their permanent establishment or any UAE sourced income or any other income that is attributable to its nexus. Such UAE sourced income would include income derived from a resident person or derived from any permanent establishment in the UAE belonging to the non-resident, or any assets or activities performed in the UAE by that non-resident. So the UAE exempts certain types of income from corporate tax, including dividends and profit distributions from resident companies, foreign dividends and other profit distributions, and capital gains arising from participating interests. Participating interest must meet certain conditions, such as holding the interest for for an uninterrupted period of 12 months or more, being subject to a tax rate not less than 9% in that respective country if it's a foreign jurisdiction, or it is at least taxed in the UAE, and owning a 5% interest in the investee jurisdictional person. Finally, income from a foreign permanent establishment meeting certain conditions, and income from non-resident entities operating aircraft or ships in international transportation may also be exempt. So let's move on to taxable income and specific deduction limitations. Calculation of taxable income in the UAE. Like most tax jurisdictions, is pretty straightforward and involves the adjustment of any unrealized gain or loss, any exempt income deductions, which we will further see in the next slide. Transactions with related parties and connected persons, tax loss reliefs, and incentives or special reliefs for qualifying business activities, or any other adjustments as may be specified from the taxable business profit. So these are all the adjustments that would be required to be made to come to the final taxable income. And here are the specific deductions and its limitations. So here are the specific deductions allowable in the CT regime and some restrictions. Expenses incurred solely for business purposes are tax deductible with some exceptions. So capital expenses and expenses related to exempt income cannot be deducted. So for example, any income specifically used to gain dividends would any expenditure would not be subject to deduction. Interest expenses are deductible only up to 30% of the earnings before interest, tax, depreciation, and amortization, with any excess to be carried forward for 10 tax periods. Interest on related party loans used for profit distributions or capital acquisition is not deductible unless it can be shown that the loan was not for tax avoidance. Here, the burden of proof in all likelihood would fall on the taxable person. So, any capital interest expenditure to related parties would be 100% disallowed as deduction. However, any working capital loan and the interest expenditure on it would be allowed as deduction for up to the standard rate of 30% of EBITDA. Only 50% of entertainment, amusement, and recreational expenses for customers, shareholders, suppliers, or other business partners is deductible. So this includes any accommodation, any membership fees, etc. Finally, no deduction is allowed for donations to non-qualifying charities, fines, penalties, or illicit payments such as bribes, as well as for dividends, profit distribution, and other benefits to owners, business withdrawals, corporate tax paid, recoverable VAT, and foreign taxes paid. no deduction would be allowed for any of these expenses. So let's come on to the reliefs. Uh, so how tax losses can be offset? Losses incurred by a business in one period may be carried forward and offset against taxable income in future periods, but there are certain restrictions. Firstly, the loss carry forwarded is capped at a maximum of 75% of the taxable income in each of these future periods. Additionally, the losses may only be carried forward indefinitely if the same shareholders hold at least 50% of the share capital from the start of the period in which the loss was incurred to the end of the period in which the loss is offset against the taxable income. However, if there is a change in ownership of more than 50%, losses may still be carried forward as long as the new owners carry on the same or similar kind of businesses. It is important to note that tax loss relief is not available for certain losses such as loss incurred before the date of commencement of CT, loss incurred before a person becomes taxable person under this decree law, or losses incurred from an asset or activity that the income of which is exempt or not taken into account in the CT regime. It would be interesting to note that the tax losses can be transferred to certain other entities. So the new UAE corporate tax regime also allows transfer of losses between taxable persons subject to the following conditions. First of all, both companies must be jurisdictional and resident person, meaning they are recognized as legal entities and have a registered address in the country. Additionally, either one must have a direct or indirect ownership interest of at least 75% in the other, or a third party must have the level of ownership in both companies. It's important to note that neither company can be an exempt or qualifying free zone person, which means they can't be entities that receive special tax treatment or operate in designated free tax zones. This was previously discussed in the free zone point. Also, both companies must have the same financial year and use the same accounting standards for the financial statements. Finally, the amount of tax loss offset can't exceed 75% of the taxable income of the company using lots. It's a complex set of conditions, but for those who meet them, the potential benefits could be significant. So some other reliefs, small businesses with a taxable income less than 375,000 dirhams would, in addition to not paying any corporate tax, would benefited from numerous compliance burdens, such as benefited from removal of numerous compliance burdens, such as transfer pricing disclosures. So, and a lot of other compliance burdens as well. So any small businesses would not be required to file disclosures for transfer pricing or follow GAAR requirements, and they would be relieved from all such burdens. The business restructuring relief would ensure that any gain arising from any corporate restructuring, such as an amalgamation or a joint venture, any corporate restructuring would not be taxable. So, as already discussed, here is the standard CT rate of 9% for taxable income above 375,000 dirhams. The new UAE regime also introduces withholding tax. However, the same has been kept at 0% for now, and the cabinet is likely to gradually make certain activities eligible for withholding tax in the upcoming years. Any foreign tax credit is also eligible to be reduced from the taxable amount, subject to some conditions such as all required documentation is present while claiming such credits, and excess foreign credits cannot be carried forward in succeeding years. So compliance is under the corporate tax regime. So once the CT regime is applicable from the 1st of June, businesses that are subject to corporate tax are required to carry out corporate tax registration in the UAE and obtain the tax registration number. The Federal Tax Authority, so this can be enacted on the FTA portal, and the FTA can automatically register a person for corporate tax if the person doesn't register voluntarily. Despite enjoying the 0% tax rate, free zone persons will also be eligible to register and file returns with the FTA. So, also, dormant companies or companies with zero income would also have to file if they are registered with the FTA. The regime's payment and compliance deadline allows taxpayers a generous time frame of 9 months from the end of the financial year to ensure a smooth transitioning to this new regime. So, for example, for a business having its financial year from the 1st of June 23 to May 31st, 24, it can file its tax return till the 31st of March 2025. The returns will be prepared in a self-assessment basis, meaning that all the tax requirements and calculations will have to be done by the assessee itself. However, it would be important to keep in place all necessary documents as evidence for a minimum period of 7 years from the end of the relevant tax period in case the authority asks for it. And there is no advanced tax mechanism in place, so the tax liability would have to be paid at the time of filing the return. Also, the authority may request for submission of financial statements and issue a decision requiring audit of financial statements of some businesses. So moving forward to transfer pricing and GAAR regulation. So transfer pricing and GAAR provisions. Transfer pricing is certainly new in the UAE, and it's going to apply for transactions between related persons and connected persons, so including foreign jurisdictions. So both these definitions are separate as provided in the CD regime. Connected persons would include any directors, officers, owners and the related parties of such owners, whereas related parties would mean two or more individuals who are related within the fourth degree of kinship or affiliation, and an individual and a legal entity where alone or together with related parties, the individual directly or indirectly owns more than or equal to 50% share, controls a legal entity. Two or more legal entities where one legal entity is alone or together with a related party, directly or indirectly owns more than 50% of the other entity. Similarly, two or more legal entities, if any natural person alone with a related party directly or directly owns 50% or more shares of each or controls them. Taxpayers and its permanent establishment, whether local or foreign, and partners in the same unincorporated partnership, a trustee or founder or settler of the same trust. So what does the control mean here? Well, the control would mean the ability to exercise more than 50% of the voting rights of another person, ability to determine the composition of more than 50% of the board of directors of another person, ability to receive more than 50% of the profits, or the ability to determine or exercise significant influence over the conduct of the business affairs. So this would mean that within 30 days of a request from the authority, every entity would have to file disclosures for all such related party transactions. Furthermore, any payment in excess of the market value of payments done to connected persons would be disallowed from deductions. So here are some relevant VAT amendments which is in effect from the 1st of January 23. Just to quickly brief over this, amended VAT laws allows registered taxable person to apply for registration exceptions, making only zero-rated suppliers. So earlier it could only apply for such exceptions at the time of registration, but now you can apply it at any time. In case of continuous supply, where the rate was not triggered earlier, it will be determined maximum on the date on which 1 year has passed from the date. So this is in regards to the time of supply in case of continuous supply, whereas a tax invoice has to be issued within 14 days of the continuous supply. The taxable person requires to recover VAT paid or declared on the import of goods or services, and where the taxable person applies an incorrect tax treatment, tax credit is required to adjust the tax output tax within 14 days from the date on which the instance requiring adjustment was happened. And a voluntary disclosure, a VD, which is a provision to edit your previous tax returns, cannot be filed by the taxable person after the lapse of 5 years of the relevant tax period in which such VD has to be taken place. So tax groups and the taxability of group companies and branches. In the UAE, a parent company can apply to the FTA to create a tax group with its UAE subsidiaries, provided that certain requirements are met. These requirements include having a 95% ownership. Neither the parent nor the subsidiary can be a qualifying free zone person or exempt person. All companies must use the same financial year and accounting standards, and a threshold of 375,000 dirhams will apply to the tax group as a single taxpayer, regardless of how many entities are included. So if a subsidiary joins a tax group, any unused tax losses of that subsidiary will become carry forward tax losses of the tax group and can be used to offset taxable income of the tax group as long as that income is attributable to the relevant subsidiary. However, if a new subsidiary joins an existing tax group, the existing group's unused tax losses cannot be used to offset taxable income attributable to the new subsidiary, so that there is no misuse of these powers given. Finally, intra-group transfers will not be subject to transfer pricing regulations since they will be offset within the common group consolidated financial statements. If in the new regime, the taxable income and corporate tax return of the UAE or parent or head office will include the income of its UAE branches. However, a UAE branch of a foreign company will only be subject to the UAE corporate tax if its activities create a permanent establishment in the UAE. If a UAE business has foreign branches or permanent establishments, their income will also be included in the taxable income and UAE corporate tax return of the UAE parent or head office. However, the UAE business may choose to claim foreign branch profit exemption. If the exemption is not claimed or the income of the foreign branch or PE is not eligible for exemption, the UAE corporate tax payable on that income can be reduced by the tax paid in the foreign jurisdiction to avoid any double taxation. So some other key points. The tax period has to be a calendar year or 12-month period for which the taxpayer prepares financials. All amounts are to be quantified in dirhams. Corporate tax assessments and penalties will be conducted in accordance with the tax law. The provisions of the tax treaty would prevail in case of inconsistency between any tax treaty and CT law. So this was seen with the new tax residency laws, wherein the 183-day rule would supersede the 90-day tax residency rule in case of a valid Emirates ID or a valid visa. And the closing balance sheet for the year prior to the first tax period shall be considered as an opening balance sheet for the CT purposes, subject to transfer pricing. So what next? After this CT was released, a lot of speculations and a lot of uncertainties came into rise, such as business or business activities that will be subjected to UAE CT to be issued as per cabinet decision. Although withholding tax is currently set at 0%, the authority may levy withholding tax for specific transactions and items. The authority may bring a higher tax rate of 15% for larger multinational companies to align with the OECD's base erosion and profit sharing pillar 2, which is the global effective minimum tax rate of 15%. Determination of qualifying income for the purposes of a qualifying free zone person is certainly one of the most important and crucial aspects which is left uncovered by the CT. And hopefully in a few further years or a few further cabinet decisions, it would certainly be clarified whether qualifying income includes anything more than just the sales or business income and not the mainland income. So thank you for listening. Please let me know if any question arises. I'm happy to help.